Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Brian.
I'm Will.
So, okay, guys, the Fed came out with their interest rate decision, and they did their press Q&A again. We're going to talk about that today and really just what that means over the next 6 weeks for mortgage rates and maybe even beyond 6 weeks. We just talked about interest rates on our last show, but now that the Fed's made these comments and made these decisions, we have to circle back already and talk about what this all means.
Hey, Brian was just talking about Toy Story here, that his son is all about mine.
Now
and
my
now
rates.
we're talking about rates.
100%.
So, I mean, to start it off, I guess the Fed's decision was that they're holding steady, and they're going to be monitoring, the data that comes out these next 6 weeks until they meet again to really see what their next move is going to be But based on everything that we did see and what we heard, it's going to keep going up.
Yeah, but this is pretty crazy, right? After 10 consecutive rate hikes.
Yep.
We started off at, 0.25%, and now we're at 5.25%.
Yeah.
It's quite a relief just to see that they didn't increase the rate. I mean, that's
At
much
least
to
not
celebrate.
for now, yeah.
I think the pause is temporary, right? Because they kind of alluded to
Like
it.
a Band-Aid on the Band-Aid real quick, but there's more to come.
There's more to come. I mean, they did as much in admitting that saying that future rate hikes may be necessary, but that also those Fed members surveyed say they think their average needs to be 5.6 by the end of the year, which means we will find ourselves in a range of 5.5 to 5.75. That's 50 basis points essentially from where we're at now in the current range of 5 to 5.25. And that just means that all rates are going to follow in that same direction for the foreseeable future.
Yeah, and it's just tackling like right off the bat, mortgage rates. I mean, we're going to be right up, very honest. It's going to continue to stay at an elevated height of the rates.
Of course.
I mean, with everything happening, prices not slowing down. I mean, this is only going to make things even worse as we see it digest into the markets. But one thing I did want to see that I did notice was that the Fed, most of them, had different opinions of what was going to happen. Some of them were like, we could foresee rates to come, the Fed fund rate to drop to 4.6 in 2024, and then their goal of 3.4 in 2025. Now that sounds great and all, but that's still a long way to go for us to be like, okay, I think that's for sure going to happen. But there is some positive outlooks from the members of the FOMC that are looking for a positive drop next year.
But that sounds far. That
But
sounds
that's
far.
so
away.
sounds far.
2024,
I mean,
2025.
we're 6 months into the year, and then 2024 is another 6 months. But these 6 months, as we've seen, have been so volatile that so much has happened.
And that's what I'm saying.
Can we even make it to the next 6 months?
2024 and 2025, can we do something now in 2023, right? But no, instead we're hearing the contrary. 2 more rate hikes are expected, accordingly to how inflation goes, the unemployment and all that other good stuff. So people, again, we keep saying this, stop spending the money. The more you continue to spend, we're giving this false idea to our federal government that everything's okay.
And I don't know the exact numbers, but I know that the job reports came in better than expected, and consumer spending is still high. Consumer prices are still high as well. So it's kind of like, where are we seeing this, drop if it is happening?
And it gets tricky. it gets tricky, right? Because you have the jobs reports that come out, but then they have the revised job reports, which have been suspiciously coming out actually worse weeks later after they were initially reported. There's an issue there, number one. Number two, the other thing I think is that they're commenting on is the demand. Normally they can start easing or see disinflation when demand goes away, but demand has curbed, but it hasn't stopped. Yeah. It hasn't been this dramatic impact they were hoping to have. And the numbers are reflecting that. Consumer inflation is still in positive territory. The confusing part, and I don't like that they do headlines this way, is they go, oh, inflation has slowed or inflation has cooled. The word inflation means it's still going up. So until you say inflation is flat or is going negative, it actually isn't disinflationary.
It's the way they package it and sell it to you. So it's slowing down.
You can say 0.1 month over month, or you can say 0.2 month over month. That's still increasing in cost. Yeah. Relative to its previous reading. So inflation has not stopped yet. And we have to get to this stopping point before they can start curbing their rate hikes and then giving us back some of these basis points, right? They want to get to 4.6 by the end of next year. Okay, so let's just measure that out. It's June 2023. They want to be by the end of next year 100 points better than where they want to end up. So we have 2 more rate hikes this year probably.
2 more.
And then they're going to carve off 100 over the 12 months that go January to December 2024.
Yeah. So again, what does that mean? If they increase the rate again in July, right, is where anticipated, some people are predicting we got a 70 to 80% chance that the rates will actually increase. The Fed will increase it by another 0.25% at that point in time. Pay your credit cards off, right?
Yeah.
Because it's going to cost you more.
Yes.
So continue to pay off your debt. I know I called my wife and said, Tanya,
wipe it all down.
let's pay these things. You know, I want to borrow my money for cheaper. So
Yeah.
No, and I think it's an overall good opportunity for consumers to really, you know, narrow down what it is that is important to them, really just, you know, fundamentalize what their next moves are going to be, because this little break might be that little positioning in them that could get them that house that they need, or, you know, just that break that they need to basically pay off what's coming. I mean, pay off the credit cards or any debt that they're dragging along, because later on we see that credit cards are, you know, tied to the federal fund rate. So as soon as that thing goes up, I mean, your payments are going to go up as well. So, I mean, yeah, definitely.
Yeah.
You know, one thing that was interesting then when they talked about how, you know, how inflation is kind of measured, you know, there's like housing inflation, and housing related things are one big part of this. And then there's the non-housing sector.
Yeah.
And the housing sector, Jerome Powell even said we're experiencing a bottoming effect. So he's like and it kind of like went in between these other comments he was making, but I caught it because it made me think about our other conversations about how buyers are back and how buyers are now not being deterred because they do not see the slide that might be happening in other parts of the country.
Yeah.
They're not happening here in San Diego. The demand is still there, despite mortgage rates being the cost that they are. People are still coming to the market. Multiple offers, like you had a story, Brian's had a story. We hear more of them, so we're still closing people on purchases, but it's not without. It's still with competition.
Yeah.
But the bottoming is really important because here's the issue. He did not talk about this. If we have a bottoming in housing, and let's say the pie of inflation is split 50-50, it's not. But let's just say 50% is housing related. But if it's bottomed and it's going back up again, and that's baked into the inflation number, then we are now not able to fight inflation as much as we wanted to because the behavior is baking it into the cake.
Of course.
Wow.
Yeah. What a false expectation there.
So that means that the services sector is going to have to like fall off a cliff to make up for this, like this revised confidence of prices being where people are still have an appetite for it. Well, that's going to be still baked in that number, which means their fight against inflation, in my opinion, just got a lot harder because they're going to now have to weigh and lean way heavier on the services sector to have disinflationary pressures to outweigh this new buyer demand and this bottoming of prices in homes.
Yeah.
So what does this mean for the real estate market? Do we expect prices to come down? Do we expect rates to continue to go high? I mean, what are people to expect with this Fed rate to happen to the real estate market moving forward?
Number one, you're going to see rates go higher. I think rates are just going to go higher, but there's also going to be a tolerance, right? There's an appetite. People are going to go, okay, too much is too much.
Correct.
So we're going to hit a ceiling at some point. I don't know if it's going to be in the next couple weeks or the next couple months in the summer. They'll hit a threshold there. Number two, I think you're going to see people that are going to have to still sell, but there's going to be multiple buyers. And the people who who are maybe having economic hardship that would be facing normally foreclosure, they're going to list their homes. Yeah. So I think there's still going to be inventory that comes from that.
Yeah, and I mean, I hope that comes true because I mean, just recently this week we got beat out by another 14 offers.
Oh no! Oh really?
Yeah. So when you say that demand is still there, and I actually brings up a story that I was talking to one of our account executives out of Michigan, and he mentioned to me, he's like, you know what's crazy about the San Diego market so far, that it's on the end of everything that's happening. So you guys are getting the last of everything that's happening. So before it was like from the West Coast over, but now all the other markets are basically falling first, and San Diego's yet to see a significant drop. And he's like, so I know you guys are still very busy. I'm like, bro, I just got beat out. Like, he's like, so you guys, I mean, are still on the end of everything that's happening in other markets, but I mean, it's still a good opportunity because San Diego's still full of people that want to buy, and as we're seeing, the demand's still there.
Well, the demand's still there, but it's going to cost a lot more now.
Yeah,
right?
of course.
So at least we anticipate from here into July, if they don't increase the rates in July, and if they do in that point in time, it's going to cost you more to get into that house. So start saving more money.
Yeah.
That's the only way to counter that, you know, the higher rate is by putting more money. So,
and I know Brian talked about this before on another show. We talked about, you know, if you have an interest in some sort of side hustle, go at it. Like, go for it right now. You know, we talk about decreasing debt. We talk about increasing income, saving for that rainy day in some cases, but also saving for a higher down payment. I would be very surprised if we don't see another resurgence of some sort of like first-time homebuyer program get refunded, and that might be coming back on board for something. I don't know.
So I mean, I know that San Diego Housing Commission came out with a grant for Black people and people of color.
Yeah.
And it gives you up to $40,000 for closing costs and or down payment.
Yes.
And some of it is in the form of a loan, and the others are part of a grant. So I know that I've been hearing a lot of buzz on that, and we'll see how how impacted how much more impact that's going to bring to the San Diego market more than we already have. But then it goes back down to the AMI and the area median income. So it's really difficult for everybody to fall under those characteristics, let alone have the income and then be able to go into bidding wars.
And that's the thing about these conversations, whether we're talking about the Fed, talking about the data, talking about mortgages, or even programs locally in neighborhoods, there's still like nuance to it that still matters. And I think that everyone just wants to like run to what's the top line say, and then just, okay, this is great. But there are conditions to it. And there's reasons that it doesn't work for everybody, even if it's well-intended, because most of these things are well-intended, but there's things you just have to know and you have to dig into to really get to the bottom.
And it goes based off a zip code, right? So depending on what zip code you're at, the AMI is going to be different.
Correct.
And a lot of those zip codes don't allow for, that higher income. So
we hear Rocket starting off that, the 3% or the 1% down from the consumer, and they put the other 2 as a grant, right? But the max loan limit is $350,000.
Right.
Then it has the AMI, which kind of in California, I don't know that that's going to be possible. But here's the thing, guys. Here's the thing, okay? Back in 2008-9, people were going in foreclosure. Who was the highest ones going through the foreclosure and just letting go of their properties?
Unfortunately, people of color and Hispanic, Latinos, and the minorities.
It could have been. I don't know that I'm going to agree with all of that.
Okay,
perfect. I'm going to say the people that actually didn't put as much money down, didn't have a lot of skin in the game.
Economic leverage.
Okay.
Yeah.
So those are the people that just kind of said, hey, you know what? I didn't have much to lose. If I'm going to put 1% and I'm having a financial struggle, employment, etc., I can't keep this property. It only cost me 1% to get in.
Yep.
And so therefore that's the likelihood of that, or an investor releasing the property is higher likely. And that was proven fact from other times when we found ourselves in a difficult market.
They didn't have as much skin in the game, right? I mean, you could do an 80-20, 100% finance. People didn't have to put out $20,000, $30,000, $40,000 of their own hard-earned, saved money to participate in the housing crash.
Yeah.
boom, then crash.
And here's the other, with VA, they put no money down, but that has the least amount of default.
That has the lowest default of all loan types.
All loan types, which is
I don't think people know that.
Well, now they do.
Well, we at this table know that. I don't think a lot of the public knows that, because I don't think it's actually talked about.
Yeah, correct.
But VA loans do have the lowest deficiency and defaults of all loan types.
And then just remember, whenever you're putting the least amount of money down in lending, it's all about risk factors, and that's why we check credit, we check income. When you're doing that 1% and all that stuff, I mean, yeah, they say that the rate's going to be more in your favor in certain situations, but look at all the red flags that they put, like the AMI, average market income, right? Well, maybe with my certain income, I can't afford that now.
Yeah.
And so these are the things that I feel like they kind of put these obstacles in place to, maybe not get you in that property, but they want to make something out there, make something up to just entice.
Yeah.
And that's what I was going to say. I feel like it's a great tool to get people in. Maybe not keep them in there, but still be able to keep them and put them under another bucket.
Yeah.
Yeah. Yep.
But how do we prepare for all of this, right? Like how can we just prepare for all this information that's happening? Because I wish we could see a crystal ball and say for sure this is what's going to happen.
Well, I think immediately there's not actually a ton of economic data that's going to come out between now and the July meeting. There's a couple of important things, but not as much important things as we just saw over the last couple of weeks here leading up to this meeting. So I think there's less to look at. So that means we have to kind of zoom out, take a wider view. So I think that's number one for me, answering your question, is zoom out and look at the bigger picture and take a longer time frame. So zoom out and go, okay, what's happened over the last 3 months, and what does all of that combined tell me about pacing forward? And then how do I look at my own life in the next 6, 12, 18, 24 months, not just, July only. Yes, we have our eye on July, but I'm looking downfield, downrange another 2 years going, okay, what do I need to adjust today so that my tomorrow is
Absolutely.
better?
There you go.
I think for me, I believe that, with all the information that's out there right now, using it to make an informed financial decision, really prioritizing what debts you need to pay off. And if you're, currently investing and your investments aren't returning the gains that you're looking at, look at alternative investment routes that right now can help you hedge against inflation.
Yep.
So, I mean, that's overall what I can do is plan, prepare, and still persevere.
That's it.
The PPP has been like literally the theme of all year.
Yep. Yeah. Yeah.
Diversification.
Yeah.
And
That's
there's,
where to
gonna,
go.
and there's going to be a lot more with this conversation, guys, as the weeks go on. But, you know, that's that. The Fed paused this week. There's a lot of things that's going to mean once more data comes in. And we'll be fielding questions. So if you're listening to the show or watching the show, you have any questions, you can reach out to William, you can reach out to Brian, reach out to myself so we can help you. You want to make sure you win in real estate this year and also in the future years. So thank you guys again for joining me today. And thank you so much for watching and listening. Be sure to subscribe on YouTube or follow the show on Apple and Google Podcasts. And we'll see you again next week.
There you go. See ya.